Well, thank you for joining us for the Metrics Credit MCP Master Income Trust webinar. My name is Mark Cormack and I'm a Director with Pinnacle Investment. Pinnacle are distribution partners for the Metrics Credit business. And today I'm delighted to introduce you to Andrew Lockhart, founder and equity partner of Metrics Credit. But before I hand you over to Andrew, I'd just like to say a few key points on Metrics. Metrics are about to IPO the MCP Master Income Trust. And this will provide investors with access to the Australian corporate loan market. This is an asset class that has not been accessible for retail investors in the past. The Metrics IPO targets an income return of RBA cash plus 3.25% net of all fees and expenses. And this 3.25% above RBA is currently sitting at 4.75%. And this investment will be via a portfolio, and it's a diverse portfolio between 70 and 100 floating rate corporate loans. And income in this investment will be paid monthly. Investment in the MCP Master Income Trust will broadly replicate lending activity by the banks to corporate Australia, and this will be in a capital stable investment. The offer also seeks to raise between $100 and $500 million, and after week one, we're pleased to announce we've already got committed interest of around $260 million with Cornerstone and other indicative bids. The offer has no options attached, and all upfront costs are being capitalised and amortised over a 10-year period. And this will mean that units will list on day one at the subscription price of $2. So without further ado, I'd like to hand you over to Andrew Lockhart, founder of Metrics Credit, who has over 30 years' experience in loan origination, structuring, and portfolio risk management of loan books. Thanks, Andrew.
Thanks, Mark, and thanks everyone for taking the time to listen to our proposals and offer. A little bit about Metrics Credit Partners. We established our business in 2011, launched our first fund in June of 2013. Metrics Credit Partners is a business that's dedicated to direct corporate lending. The first fund that we launched in June of 2013 started with one single investor originally for $75 million. The fund's now grown to well in excess of $2 billion over the last 4 years. In November of 2015, we launched a second fund, the MCP Secured Private Debt Fund Strategy, dedicated to direct corporate lending to mid-market corporates. That fund has performed well since November of 2015 and delivering strong returns for our investors from direct exposure to corporate companies that we lend to, or companies that we lend to. As a team, our team has a strong skill set around the direct origination, the ability to structure, negotiate, and arrange facilities directly with Australian corporate borrowers. So we're engaged directly with working with banks and corporate advisors and borrowers directly, seeking to negotiate terms and conditions upon which we will lend, and providing our investors with direct exposure to those assets. As a team, we've completed in excess of $3 billion of transactions, and over 80 individual loans have been made since the first fund was launched in June of 2013. You can see on the chart on the screen there that we lend to a range of publicly listed companies. We provide financing to project and infrastructure, government PPP-backed financing requirements. We provide funding for property-related purposes, both for development and also for REITs. And we also provide financing for acquisition purposes for private equity borrowers. You can see on that chart there are a range of companies there that some are well known and some are companies that are private companies where investors don't get access to either the debt or the equity. In a number of those transactions, Metrics Credit Partners, we're the only non-bank lender to those companies. We're participating in those transactions alongside the banks on terms and conditions with pricing and access to security in exactly the same manner as a bank. So when we lend, we're lending alongside those banks to provide the total financing requirement for those corporate borrowers. The Australian market's unusual. In Australia, we don't have a deep, liquid, functioning corporate bond market where corporates are able to access alternative sources of debt capital. Most corporates are heavily reliant on banks for funding. In the Australian syndicated club-style loan market, the banks and ourselves complete in excess of $100 billion of transactions every year. There are around about 90 banks globally that participate and provide that financing. However, in Australia, not only do we not have a deep, liquid, functioning corporate bond market, but banks are also facing into increasing regulatory pressure, requiring them to hold additional amounts of capital against assets, and also their financing mix has changed. That's resulting in a situation where, in our view, the cost of finance for corporate Australia has an upward bias in terms of the total price of provision of corporate debt. But when a corporate tries to access alternative sources of debt capital, they're quite difficult to access those alternative markets, be it the Australian bond market. Most corporates, to access that market, for instance, would require a credit rating, whereas most Australian corporates do not have a credit rating. The size of that market is small and immaterial when compared against the loan market. In the top end part of the institutional wholesale part of the loan market, we estimate there's in excess of $250 billion of outstanding loans. The Australian bond market, Australian corporate bond market, provides outstandings of around about $40 billion. So it's a materially smaller, less diversified market than the Australian corporate loan market that provides a far greater level of diversification to investors. Also, it's difficult to access certain markets. So, for instance, on that slide on the page, the page on the slide that's in front of you shows the US private placement market. That's a market that's difficult to access for most corporates. They need to be investment-grade corporates, and they'll often require hedging requirements provided by banks. Those hedging requirements are not necessarily available to most corporates for the terms that they would look for. If we think about the Australian market and where we sit in the risks and the risk and return spectrum, a lot of investors in Australia have access to AAA, AA government bonds, semi-government bonds, or AA rated instruments such as bank bonds. Often in a ETF, for instance, a corporate ETF in Australia might have the 4 domestic major banks and only 1 or 2 corporates. It's not a heavily diversified opportunity set. And the reason for that is the banks use that capital and they on-lend. And they on-lend generally between credit ratings of A to BB in terms of credit risk. And that's a market that is dominated by banks. In other markets, it would be a corporate bond market. In Australia, it's a market where the debt requirements of corporates is provided by banks, and those assets are retained and held on bank balance sheets. At the other end of the risk spectrum, some investors have had exposure to higher yielding debt opportunities, be it mezzanine finance or US-style loan market opportunities. That's at a different end of the risk spectrum, generally from B to down to D in terms of credit rating. In Australia, that market does not exist. It doesn't readily exist. It's a bank-dominated market, and the credit quality of those issuers generally reflect the regulatory and legal framework upon which banks lend in the Australian market. When we look at the chart there on the next page, you can see that the loan market, or the price for which corporates borrow, there's a consistent spread between the base rate, the RBA cash rate or BBSW, and the margin upon which banks lend to corporates. Our view is that there's an upward bias to that, and that really reflects the changing regulatory dynamic faced by banks in terms of the change in terms of their own financing mix, where banks are required now to have longer or more stable financing, and also required levels of capital to be held against assets. So when a bank lends, they're looking to generate a minimum return on equity for their shareholders. So to lend inside that margin would be dilutive to returns to shareholders. And so as a result of that, you get a stable pricing market, a market that prices stable and prices risk according to the minimum returns that a bank would need to generate to drive the right return on equity. On the right-hand side of that chart, it's showing you the historical loss rates that the banks have faced, and that's really an example of, I guess, as a private side lender, two things that are important to understand. One, Australia has a regulatory and legal framework that is very friendly towards lenders, particularly where a lender holds security. The corporate insolvency framework available to lenders and the protection that provides a lender is a means to mitigate the risk of downside loss. And as a result of that, you've seen the banks experience low loss rates as they've made loans to corporate Australia. The second thing that's important is that as a private side lender, it's our position to understand the credit risk, understand the company that we're lending to, understand the sources of cash flows that are generated by the borrower and the security that's available to be held, and to negotiate and structure terms and conditions seeking to mitigate the risk of downside loss. So as a lender, we spend a substantial amount of time analysing and assessing the creditworthiness of corporate borrowers that we lend to, and then we look to structure terms and conditions alongside arrangements with banks to facilitate financing that mitigates our risk of capital loss. At Metrics, we have a view that we prefer to lend on relatively short terms, generally loans between 3 and 5 years. And we do that because we believe it reduces the credit risk an investor is exposed to, reduces the market volatility and the returns or market risk that an investor is exposed to, and it gives you the right as a lender to reset terms, conditions, pricing and covenants on an ongoing basis, and it also gives you a means to seek repayment at a particular earlier phase than would otherwise be available. The chart on the screen there now is really just showing the historical returns from alternative asset classes. Australian loans are not represented, but Australian corporate bonds provide a slight proxy to it. However, because corporate loans that are made on a floating rate basis with protections for lenders in the form of security or controls, covenants and conditions that are imposed upon borrowers, you find that the stability of capital and the predictability of returns is less volatile than in other asset classes. Yet in Australia, most self-managed super funds or other investors really don't have investment portfolios that provide opportunities to invest in a stable cash-generating asset class. Often you see portfolios that are heavily weighted towards equities, property or cash. Generally, investors just have had limited opportunity to get direct access to a diversified pool of Australian corporate fixed income opportunities. At Metrics, that's what we're seeking to provide our investors. So when we lend, we see ourselves as an aggregator of capital that allows us to aggregate investor capital and to invest in a size and scale commensurate with the way in which a bank lends, offering our investors a greater opportunity to invest directly with the benefits of size and scale afforded to a lender consistent with the way in which a bank would lend. I'd like to thank you all for taking the time to listen to the presentation today, and if you have further questions, please feel free to get in contact with our various distribution partners.